As of this exact moment on Thursday, January 8, 2026, NVIDIA Corp is trading live on the NASDAQ at $184.25 USD, marking a decrease of $4.86 or about 2.57% for the session. While the ticker flashing red might suggest a cooling off to the casual observer, the internal mechanics of this move tell a far more complex story about where capital is moving in the early days of 2026. Most traders looking at their screens right now see a stock that is simply taking a breather after a historic multi-year run. But the reality is that we are witnessing a massive structural rotation in how institutional portfolios are being weighted. While the surface-level narrative focuses on whether the AI boom is slowing down, the data behind the scenes shows that the demand for high-performance compute is actually accelerating into a second stage of infrastructure building that many analysts completely overlooked. This gap between the expectation of a bubble burst and the reality of a global industrial upgrade is where the real opportunity for a smart individual brokerage user sits right now. When you look at NVIDIA stock in the context of the broader market, it is easy to get caught up in the daily noise. People often check their Robinhood app or log into their Fidelity trading platform and see these 2 or 3% swings and assume something is wrong with the underlying business. The common belief is that once the initial wave of data center buildouts is finished, companies like Microsoft, Meta, and Alphabet will stop buying chips at this scale. This expectation of a cliff-edge drop in demand is what keeps the bears vocal. However, the reality of the situation, especially following the recent CES 2026 announcements, is that the market for this hardware is expanding into sectors that were previously untouched. We are no longer just talking about large language models. We are talking about the complete digitization of heavy industry, a move that requires more compute power than the entire internet combined a few years ago. If you are using tools like Schwab Intelligent Portfolios or other forms of online investment platforms, you might notice that the weighting of tech is being scrutinized more heavily this month. This is because the market is trying to price in the shift from the Blackwell architecture to the upcoming Vera Rubin series. The expectation was that Blackwell would be the peak, but the reality is that Jensen Huang has successfully compressed the innovation cycle to an annual cadence. This means that by the time competitors like AMD or Intel catch up to the previous generation, the goalposts have already been moved. This creates a massive moat that is reflected in the mid-70% gross margins that continue to defy the gravity of the hardware industry. While most hardware businesses eventually see their margins compressed as products become commodities, NVIDIA has managed to keep its pricing power because it isn't just selling a chip, it's selling a full-stack software environment that is incredibly difficult for developers to leave. Think about how you interact with your own portfolio. Whether you are using Fidelity Wealth Management or doing some self-investing through interactive brokers, you are looking for companies that have this kind of lock-in effect. Many investors expected that as the Fed held rates or signaled only modest cuts, the valuation of high-growth tech would naturally compress. The reality is that the earnings growth is outpacing the multiple compression. For NVIDIA, a price-to-earnings ratio that looks high on a trailing basis actually looks quite reasonable when you factor in the $65 billion revenue guidance for the upcoming quarter. This is the tension that drives the current intraday volatility. You have short-term traders selling the peak, while long-term institutional buyers are using these dips to fill out their positions through a Fidelity brokerage or SoFi active investing account. Let's look at the actual movement we've seen in the last few hours. The volume is significantly higher than the average daily turnover, which indicates that this isn't just retail panic. We are seeing institutional rebalancing. Large funds that manage Fidelity mutual funds or Fidelity ETFs are likely shifting their allocations to manage risk as we enter the first full week of the year. This 2.57% drop today is a perfect example of the market testing support levels. If you look at the chart on your Robinhood stock trading screen, you'll see that the stock is hovering near its 50-day moving average. For many, this is a sign to stay away, but for those who understand the industrial AI partnerships with companies like Siemens and Lenovo, this looks more like a healthy consolidation. These partnerships are creating a new type of demand: physical AI. This involves creating digital twins of entire factories, which requires immense amounts of real-time processing that only these specific GPUs can handle. Expectation often lags reality in the tech sector. The general public still thinks of this as a gaming company or a company that helps run chatbots. The reality is that NVIDIA is becoming the foundational layer for the world's new industrial operating system. When you see news about Mercedes-Benz integrating a full-stack autonomous driving solution in their new CLA models, you aren't just seeing a car feature, you are seeing a recurring revenue model for software that runs on NVIDIA hardware. This is why the volatility on the Interactive Brokers platform can be so misleading. If you only look at the price action of NVIDIA stock without looking at the expanding partnerships in automotive and healthcare, you are only seeing half the picture. The same applies when you look at Apple stock or Tesla stock. Each of these companies is becoming more reliant on the type of high-end silicon that NVIDIA specializes in, even as they try to develop their own internal solutions. For those of you who are navigating the market through SoFi investing, or perhaps looking for investment help through Fidelity IRAs, it is important to understand the role of geopolitical factors right now. There was a lot of fear that export restrictions to China would gut the bottom line. The expectation was a 10 to 15% hit to total revenue. The reality, however, is that the demand from the rest of the world, specifically from sovereign AI projects in Europe and the Middle East, has more than made up for the shortfall. Furthermore, the news that China might approve the import of H200 chips this quarter provides a massive potential catalyst that the market has not yet fully priced in. This is the kind of insight that separates those who just use investing sites for news from those who actually understand the global flow of hardware. While we are discussing the long-term outlook, I want to hear from you. Comment below with how many shares of NVIDIA you are currently holding in your portfolio, and let me know if you are buying this dip or waiting for a deeper correction. Seeing where the community stands helps everyone understand the sentiment on the ground versus what the big analysts are saying. Moving back into the analysis, we have to talk about the competition. Companies are always looking for ways to save on their capital expenditure. If you are using a SoFi trading platform or the Robinhood app to track the semiconductor sector, you've probably seen the headlines about new chips from Amazon or Google. The expectation is that these internal, homegrown chips will eventually replace the need for third-party GPUs. The reality is much different. While these companies are making their own chips for specific tasks, they are still buying every single GPU that Jensen Huang can produce because the versatility of the CUDA software platform is unmatched. You cannot simply swap out the hardware without rewriting years of software code. This is why when you look at your Interactive Brokers account and see the performance of the broader chip sector, NVIDIA continues to stand out as the leader. It is the standard in a world where everything else is an alternative. The business model itself has shifted towards what the company calls the virtuous cycle. This is a concept where the more compute power you have, the faster you can develop new AI models, which in turn require more compute power to run. This cycle is what is driving the record-breaking data center revenue, which reached $51 billion in the last reported quarter. If you are looking at Fidelity Wealth Management or considering an online investing strategy, you have to ask yourself if you believe this cycle is sustainable. The bears will tell you that the power grid cannot handle this level of expansion. They will point to the bottlenecks in data center construction and the rising cost of electricity as the ultimate limit to growth. These are real risks, but the reality is that the efficiency of the Blackwell and upcoming Vera Rubin architecture architectures is focused specifically on reducing power consumption per unit of compute. The expectation is a ceiling. The reality is an engineering solution that keeps pushing that ceiling higher. Let's address the casual investor who is perhaps just starting out with Robinhood investments or SoFi ETFs. It is easy to feel like you have missed the boat. The stock has already seen such incredible gains over the last few years that it feels dangerous to enter now. However, if you look at the valuation relative to growth, the PEG ratio, NVIDIA often looks cheaper than many of the slower-growing defensive stocks in the S&P 500. This is a classic case of expectation versus reality. The expectation is that a hot stock must be overpriced. The reality is that if the earnings continue to grow at 60 to 70% year over year, the stock is actually quite reasonably valued for those who have a 3 to 5 year time horizon.